Thank you so much, Marva, for that beautiful introduction. Good evening, everyone. My name is Nom Sangwenya, and this evening I am with my colleague Tinashe Kunaka. We are both client relationship managers at Allen Gray. We are part of a team really that focuses on delivering educational content around personal investing to individuals, largely through in-person engagements, but we also do virtual presentations. So how we work is we partner with organizations and individuals really for opportunities to engage with people on the importance of financial literacy, saving, investing, and in so doing, building our nation. Because according to statistics, they say that South Africa doesn't have a good record when it comes to saving and investing. That is, our savings culture are not that good. Really, that's what we are trying to change as the strategic markets team at Allen Gray. As Marvel has already said, there is a Q&A option in your screen right now. So if you have any questions during this presentation, kindly send them through. Tinashe and I will answer them at the end. So on the agenda this evening, I will chat through just a brief introduction to Allen Gray, and also on the basis of budgeting. Tinashe will chat to us about setting your financial goals, why that is important, and also help you understand your investment options. So Allen Gray is a privately owned investment management firm. We were established in 1973 by Dr. Allen Gray. So we just have just over 517 billion rands of assets that we are managing on behalf of our clients. We have an affiliation with our sister company called Obus. Obus was also founded by Dr. Allen Gray. They do what we do, but on a global exposure. They just have over 33 billion US dollars of assets that they are managing on behalf of our clients offshore. At Allen Gray, we are not that big. We just have 1,412 employees and 24 investment professionals. So you may ask yourself, Nomsa, why are you isolating these investment professionals from the rest of the employees? I will explain that as we go on with the presentation. So Allen Gray has presence in South Africa, in Namibia, as well as in Botswana, while our sister company Obus has presence in Canada, in the United States, in Bermuda, the UK, in Luxembourg, in Japan, as well as in China. So our purpose at Allen Gray is to help clients build wealth over the long term. This picture that you see right now is an actual representation of our clients. Tinashe are here this evening to tell you that you don't need to be wealthy in order to invest with Allen Gray. You don't need millions to start an investment with Allen Gray. You don't need to have like a special title in order for you to be considered a client at Allen Gray. So we exist really to help people build and create a financial legacy. Anyone can invest with us, provided they meet our investment minimums and they understand our investment philosophy. So when you think about our investment philosophy, you can think about it like a DNA. That is our DNA. It is how we think about investments. It is how we go about managing clients' money. It influences the decisions that we make on behalf of our clients. Remember those 24 investment professionals I alluded to earlier? Yes, they are responsible for implementing this investment philosophy on behalf of our clients. So we don't buy shares because we believe they are going to go up. Rather, our investment professionals are responsible for going into the market and looking for businesses that are undervalued. That is, they are trading at a discount. So we look at the intrinsic value of the business. The intrinsic value of a business really speaks to how much a prudent businessman would be willing to pay for that business. And because of the market noises, sometimes that business will be trading below that. So we buy those businesses, we keep them up to a point where it has just gone above the intrinsic value. So we repeat the process over and over again. And we've done this for over 40 years now and in different market cycles. And we've been able to generate returns and help our clients build long-term wealth. An example where we're able to apply our investment philosophy was at a time, I don't know if you remember this, Nene Gate. It trended a lot during those days because it was just an example where We had Minister Nhlanhla removed as the Minister of Finance. And in that weekend, we had Mr. David Van Rooyen step in. And during that time, there was a lot of political noise and there was a lot of uncertainty in the markets. And that saw the Standard Bank share price drop by 55% in US dollars. But when our investment professionals looked at at Standard Bank as a business, they realized that there were no changes at Standard Bank. There were no leadership changes at Standard Bank, no financial changes, no organizational changes. So what was happening, it was the share price was just reacting to the noises in the market. So our investment professionals saw it fit that actually now the Standard Bank share was undervalued. So we bought more shares on behalf of our clients. Yes, everything calmed down. We saw Standard Bank share price to come and increase by over 229% in US dollars. This is one of the examples where we've been able to implement our investment philosophy on behalf of our clients and help them generate long-term wealth. So we sit here this evening and we are talking about financial literacy as a lever for economic prosperity. And I'm reminded of a quote by Warren Buffett where he said, "Do not save what is left after spending, but spend what is left after saving." So what that means to me personally is that savings won't automatically take care of themselves. I need to be deliberate about my personal finances. And like we said, personal finance is personal really. There is no right or wrong way to go about it. As long as you as an individual, you are comfortable with what you are spending your hard-earned money on at the end of the day. So I think the good place for you to look when it comes to budgeting is look at your bank statement, because it is going to give you an honest reflection on what you are spending your money on. I know, but sometimes we shy away from budgeting because it sounds a bit daunting, but we live in times where we actually have apps for almost everything. So you can use apps to help you find ways to track your spending habits. Like all of us here, we expect a successful business, right, to have a budget. I believe that as individuals, we should be doing the same thing. That is to track the money coming in and the money going out. Some of you may know the show called I Blew It. And the lessons that I learned from that show is that if you do not have a plan, you can easily misallocate your money. So you need to be intentional when it comes to your personal finances. And when it comes to creating a budget, really, you need to look at your needs, your wants, as well as your future goals. That is the money that you receive. It has to be allocated somewhere there. So when we look at your needs, we are looking at things that if you don't have them, you'll be greatly inconvenienced. That is, you can't live with this thing. You cannot not have this thing, sorry. So that is, could be your rent, it could be your electricity, it could be medical aid. So when we look at wants, these are things that can cause a minor inconvenience if you don't have them. That is, you can still be okay without them. These things just improve the quality of your life. That could be Netflix, that could be eating takeaways instead of cooking at home. It could be hobbies that you enjoy doing. So these things, you can still be okay without them. But it's important for us to also put your future goals there. I know it may sound strange, but remember that your needs and your wants, they make you happy today, but you also need to be planning for your future self. That is the person that you will be tomorrow. So through saving and investing, putting money aside, you'll be able to put money aside for emergencies, that is those unforeseen events, when life happen moments. And also you'll be able to put money aside to achieve your personal goals. It could be maybe for a deposit for a car, for a house. Maybe you want to go on a holiday. Instead of you now borrowing money for those emergencies or those personal goals that you have money put aside to help you in those moments. And what saving and investing does is that it helps you plan towards your retirement. You know, according to the National Treasury, they say that only 6% of South Africans are able to retire financially independent. What that means is that this person, even though they are retired, they can still maintain the same lifestyle that they were living before they retired. They said the rest have to depend on family. Others have to continue working, even though this person is at an age where they should be retiring and resting. They are forced to continue working because if they stop working, there'll be no income coming in. And the rest of the people also have to depend on the state pension. What these numbers really tell us is that we need to be doing more, because currently as South Africans, we are not doing much when it comes to planning towards our retirements. That's why saving and investing can help you with that. Now I'll hand it over to Tinashe to take us through why it's important to set financial goals and then help you with different investment options that are available to you. Over to you, Tinashe.
Thank you very much, Nomsa, and good evening to all our listeners today. So first, I think a very good starting point is to actually look at what exactly is investing. I know we've used that word quite a lot already tonight. So investing is simply the act of putting your money into an asset that you hope will generate a future return or will generate a profit for you. Okay, so that's what investing is in simple terms. And if we can go to the next slide, we're going to have a look at some of the different assets that Allan Gray as a company invest in on behalf of our clients so that we can try and create wealth for our clients. So starting with the highest risk category of assets that we can invest in, that's called equity. This is basically part ownership of a business. So if you have a look at your companies on the Johannesburg Stock Exchange, All Share Index, those would be companies like Pick n Pay, Woolworths, Anglo American, British American Tobacco. They're all listed on that exchange, and you can become a shareholder by buying a certain number of shares in that company. And once you actually hold on to the shares, you can hope to generate a profit by if the value of those shares increase over time and then you sell them for more than what you bought them at, that would be the capital growth. Or if you hold on to those shares and at the end of the company's financial year, they declare a profit, what they do with that profit is then they say, okay, we're going to spread a part of this profit to the ordinary shareholders in the form of dividends. So you actually get paid for holding on to the number of shares that you own. If you go less risky than equities, then you've got property. And if you're invested in property, you can earn a return or a profit in the form of rental income, or if that property is sold once again for more than what it was purchased at, that's how you can make money from property. And then we have another asset class which is called bonds, which is less risky than property. A bond is basically an instrument of debt. So imagine a company like Eskom or Transnet. It's a large organization and they want to go on a very big capital intensive expansionary project. Maybe Transnet wants to build some more new railroads and they don't want to go to the bank to get money from the bank to do that. What they could do is they could issue what they call a bond, and they say, hey, if you give us a certain amount of money, it's usually a large amount of money, we will promise to pay you a certain amount of interest, like every month or every quarter or every year. And so that's how, if you're a bond holder, you can get a return on your investment because you get those payments, that regular stream of income. And the bond can also be sold for more than what it was purchased at. And then our lowest risk category of assets that we invest in for our clients, that's cash. So if you're invested in cash or in the money market, you will just get interest on top of whatever your balance is. So there isn't that fluctuation, that volatility of your investment could go up and down, like with your equities or your property or with your bonds. With cash, it's the lowest risk. You just get interest on top of whatever your balance is. We can move on to the next slide. So as a client, as an investor, your behavior is very important. In fact, I think your behavior as a client is just as important as the role of the asset management company whose job it is to try and generate those returns for you. Because oftentimes what happens is the client actually doesn't experience the return or the growth that they could have potentially gotten in the investment because of bad investor behavior. So the investor return, that is, the return that an investment will get you if you buy it at the start and you hold on to it all the way until a certain point in time. But the investor's return, if let's say, for example, they decide to switch out of that investment and maybe move into a different one, and they try and time the market, because of that, they may actually experience a lower return than if they had just stuck out and hold on to the investment for the entire investment term. So the difference in that is called the behavior gap. And there are various reasons why that can happen. A lot of the times it can be when the investor is making emotional decisions when it comes to their investments. So sometimes when a particular investment may be on the rise, it's going up, everyone is talking about it, and people get very confident about that particular investment. And maybe greed could kick in, and you might try and buy in at a high point, assuming that it's just going to continue going up. But we know that investments don't move in a perfectly straight line. They're volatile. They go up and down. And so then the investment goes down, and once it goes down, the client may think, okay, let me pull out of this. It's too risky, and then they sell out at a low point. And then that cycle happens over and over again, where they just continue to lose money because they're buying high and they're selling low, because their investment decisions are being based on their emotions, that fear and greed. And we believe that it's actually better to spend time in the market. And it's better to spend time in the market than try to perfectly time the market and buy in and sell at the right time. No one has a crystal ball, so it's impossible for someone to do that perfectly. So that's why we say, it's better to just assume that risk and hold on to the investment for the long run. Next slide, please. And when it comes to financial literacy, an extremely important principle to know and understand is that principle of compound interest. So Albert Einstein once said that compound interest is the eighth wonder of the world. He who understands it earns it, and he who does not pays it. Okay. So what exactly is compound interest? We'll have a look at this example that's in front of us, showing the behaviors of two clients. Okay. So let's look at client A. That's the dark gray line. Client A is an investor who wants to invest for a 40-year period. And what they do is they start off as soon as possible, and they put away 1,000 rands per month, every month for 10 years. So after the first year, they would have invested a total of 12,000 rands. And then if you keep doing that for 10 years, they would have invested a total of 120,000 rands. And then they stop in putting away more money, and they just leave that contribution to grow. Okay. And then client B, that's the one in red. We see that client B for the first 10 years does not start putting away money for their investment. They only start investing in the 10th year. Okay, so they start investing late, but they contribute 1,000 rands per month, and not just for 10 years, they do that for 30 years. So after the 30-year period, they would have invested a total of 360,000 rands. So client B in red has put away 3 times as much money as client A has. But when you compare the market value of the two clients' accounts after that 40-year period, you'll see that client A's investment is worth about 1.5 million rands, and client B's investment is worth less at about 1.3 million. And this is assuming that the money is in the same fund, earning the exact same rate of return. So you might ask, how is it that client A's investment is worth more when client A has put in less than client B? And the difference for that is your compound interest. Client A's investment has had a 10-year head start than client B. And that is why when you look at, Alan Gray adverts, we always say things like the best investments take time, or, it'll say long-term investing. That's because the sooner that you start your investments, the sooner you start putting away your money, the more time your money has to grow. And everyone has, this is the most time that you'll have right now. Next year, you'll have less time than you do right now. So take advantage of that and start putting away money for your investments to try and maximize on that compound interest. We can move on to the next slide. Thank you. So where do we all start? I believe we should all start with a plan. Okay, what exactly is your plan? Your plan speaks to the goal of why you're putting away money. You know, it's very important to have a why, a reason why you're doing something, because that will actually help you to continue to do it. So write down your plan to say, okay, am I putting away money because I want to leave money for my kids or my grandkids? Or do I want to put money away so I can go on a holiday with my friends? Or maybe I'm putting it away so that I can, study and further my education. Or maybe it's just so that, I've got money as an emergency fund, in case life happens and I need money for an emergency. Or perhaps it could be for, like a business opportunity. If a good business opportunity comes about, I've got money that I can access very quickly to put into that business venture. So that all speaks to having a plan. The next step that you need to think about is the process. And the process speaks to, okay, when exactly am I going to start this investment plan? Okay, am I going to start now, or will I start in January next year? Am I going to start with a lump sum, or am I going to start with a monthly debit order that takes money off from my bank account automatically? Or is there going to be an escalation where it will automatically increase every year? Or do I want to have control over, after a year's time, what is my new contribution amount going to be? That all speaks to the process. And once you've, thought about your plan and thought about the process, I believe then your last step will be to find the suitable and appropriate product. Okay, that speaks to what type of an account it is that you want to put your money in. Oftentimes, we come across clients who start the wrong way around. They pick a product, they open up a product, and then they try to use that account to try and meet a particular need or meet a particular goal. We believe that it's better to actually start with identifying, okay, what exactly is it that I want to try and achieve? And then doing your research into finding out what's the most suitable product that can help me meet and achieve that goal. Okay. And then we can go on to the next slide, where we will then unpack some of the different products that we have at Allan Gray. So the first type of account that you could open up, I'm sure many have heard about this type of account, but we call it a basic unit trust investment account. Okay, so this is a flexible investment account, meaning that if you want to use it for, like a short-term need or something for a very long-term need, you can do that. You can also open up a unit trust account in the name of a company or a unit trust, in the name of a trust or a company, or even as a stokvel. If you have a group of friends, a burial society, and you want to open up and invest money as a group, you can open up a unit trust account in the name of a group for that purpose. But it's very important to note that that particular type of account, the unit trust account, does have tax on it. And there's no beneficiary that you can have on that unit trust account. So if the investor was to pass away or to die, the money in that unit trust account will basically need to get allocated according to whatever you say in your will, or it falls into your estate. The next type of account that one can open up is called a tax-free investment account. And as the name suggests, all the money that grows in your tax-free investment account grows free of tax. Okay, so it's a very good tax-efficient product that one can have, and the government introduced it to try and help people to save more. Nomsa mentioned that only 6% of South Africans can retire financially independent, and this is one of the good products that you could use, especially for a long-term basis, where even if it's after 50 years, that money will be growing completely tax-free. And another great benefit of the tax-free investment account is that you can actually nominate a beneficiary on that account. So if the investor was to pass away or die, the money would go straight to that beneficiary, just like some sort of a policy. The next type of account that one could open up is an offshore investment account. That account would be good for an investor who has access to, foreign currency like US dollars or euros or British pounds, and they want to keep the money in that foreign currency. Okay, let's say they've got a foreign bank account. That money would be paid to that bank account in that foreign currency. So it's perfect there. When you look at your unit trust account and you look at your tax-free investment account, your money will be growing in rands, and it would need to be paid into a rand bank account. The next type of account that we can look at is what we call a retirement annuity account. Your retirement annuity account is designed for an investor who wants to leave money, for their retirement, invest for their retirement. So not only does the money that's in the account also grow free of tax, there's no capital gains tax, no dividends tax, and no tax on the interest as well. But the contributions that you put into the account are tax deductible. What does that exactly mean? In simple terms, that means that when you contribute money into your retirement annuity account, SARS will actually pay you back money. It's tax deductible. So SARS will actually pay you money for contributing towards your retirement. The next product that you have is what we call a preservation fund. And that would be suitable for a client who is, let's say, invested in a pension fund or a provident fund, and they're working at a company, and then maybe they get a new job somewhere else, or they decide to resign. Since they're no longer a member, an employee of that company, the company will say, sorry, we can't keep your pension fund for you anymore because you're no longer an employee. And so they'll maybe give them options to say, we can either pay the money to you, to your bank account, or we can actually transfer it tax-free from that employee pension fund to a pension preservation fund. And similarly, if it's in a provident fund, it can be transferred across to a provident preservation fund. So that way, the client will continue be able to save and grow their investment for their retirement. Okay. And then for those people who have now actually, they've put money away in a retirement annuity or a pension fund or a preservation fund, and they've now reached their retirement age of 55, and they now want to access that money, they can transfer that money to what we call a living annuity, where they can receive a regular income. They can receive those regular payouts either maybe monthly or quarterly or biannually or once a year annually. But very importantly, they only have access to an amount from as little as 2.5% to a maximum of 17.5%. We can go on to the next slide. So when we look at investing, so we've already seen that the one important question that you need to identify is what type of account is it that I want to open up? The other very important decision that you need to make is what type of a fund is it that I want to invest in? Generally speaking, whether it's at Allan Gray or at another asset management company, you can break down your funds into your high risk, medium risk, and low risk funds. Your high risk funds are going to be those funds which have a high amount of equity in them, those shares which are very volatile and they go up and down, and your low risk funds are the ones that have the largest amount of cash in them, and so they are low risk. There isn't that volatility, you just get interest on top of your initial investment. So at Allan Gray, we've got the Allan Gray Equity Fund, which is high risk, which mainly invests in JSE listed companies. We've got the Allan Gray Balance Fund, which is a medium risk multi-asset fund where it invests in shares and bonds and property and a small amount in cash. But the Allan Gray Balance Fund can invest up to 75% in equity. So it's a large amount, but not as large as the Allan Gray Equity Fund. The Allan Gray Stable Fund is considered a low to medium risk fund. It can only invest up to 40% in your shares, which means it's got a much larger amount that it can invest in bonds and cash, making it low risk. And then our lowest risk investment, which is the Allan Gray Money Market Fund, only invests in money market instruments. So it's very important to make sure that you identify the fund which meets your needs and your objectives that you want. Okay. Which then brings us to the last slide, which is a quote by Warren Buffett, which I really like. And Warren Buffett said that someone is sitting in the shade today because somebody planted a tree a long time ago. And that just speaks to, taking decisions today that you or maybe someone else will benefit from a very long time from now. Thank you. That's it for the presentation. I think Marvel will then lead us in the Q&A time where we can field the questions that you've been submitting.
Hi, Marvel, you're on mute, but I can take the question that I see that came through. So Litabo asked, how much do I need to invest? Tinashe, do you want to take that?
So it will depend on which type of an account it is that you want to open up. But when it comes for that basic unit trust account or the tax-free investment account or the retirement annuity account, the minimums for those type of accounts, it's just 500 rands as a monthly debit order. Or if you want to just do like a once-off investment where you transfer money, just once off, that minimum investment is slightly higher. It's 20,000 rands as a once-off transaction.
Thank you so much. Just a reminder to our attendees that you can send through your questions. We are taking them now. So Litabo also asked, can we have the slides and the recording of this session afterwards? So you will definitely have the recording because the session is being recorded. So Marvel will forward it to you, I believe. Yes.
I think we can also make the slides available. So we'll email our BMF colleagues the PDF version of the slides afterwards.
Any other questions that you may have, kindly send them through to us. We will answer them. Okay, so Lawrence asked, what is the minimum capital needed for an equity fund investment? So I believe Tinashe touched on that the minimum to start an investment at Allan Gray is 500 Rand debit order a month, or you can do a lump sum of 20,000. So it doesn't have to be like, 500 Rand only in the equity fund. So you choose your account. Let's say, for example, you choose the basic unit trust account. That is your account. And then when it comes to choosing the fund, you choose the equity fund. So the minimum can go into that fund alone. That is your 500 Rand debit order or your lump sum of 20,000. But if you choose more than one fund, you are more than welcome to divide that 500 Rand debit order across the fund selection that you made. So the minimum will still be the same 500 Rand debit order or 20,000 lump sum.
Yeah, and just to add on that, it's another question that we often get is like, what happens if you skip a debit order? Is there a penalty? So the investments they're not like like life insurance where if you default on your payment, you lose some of your benefits, right? So it's a voluntary investment, meaning if you do have the money to invest, that money will then go into the account. If for some reason the debit order rejects or it bounces, or if you want to stop it, because like we said, we know life happens, you can stop the debit order and there won't be any penalties that will be imposed upon you. Allan Gray will just continue to grow the money that's already in the account. And then when it comes to such a time that you want to restart your monthly debit order, you can restart it once again with no kind of penalties for reinstating your debit order.
Yes. questions, you can send them through to the chat or the Q&A. We'll gladly answer them for you. Okay, then in the absence of questions, I guess we can end this session this evening. So as Marvel mentioned in the beginning, that we're going to send you a feedback link where you're more than welcome to, if maybe you want to ask your question privately, you can leave your comment there. We'll get in touch with you and also give us feedback on how you found this session.
A pleasure. Thank you very much for inviting us. We definitely do hope that you gain something that you'll take from here and implement it going forward.